Okay, so let's get into property. So it's interesting because it's 2 o'clock or 2:30 now, and I'm only spending this time on property selection. Because really property is not about property investing. It's not about the actual property itself. It's about the structure and everything else. And there's a lot of seminars out there and books that you can find about where to buy property and how to select the right property. And I'm going to give you a very specific criteria today in terms of what properties you should be targeting and why, and the logic behind it. And it has all to do with the valuation process. I'm going to go through an actual valuation with you. I'm going to show you how valuers value property, what they look for, and what you need to do as an investor to make sure that you are able to get capital growth in your property and increase your lines of credit every 6 to 12 months, regardless of what the market does. Thank you. So let's begin. And I would say the most important thing, I remember an interview with Warren Buffett, and he was asked, what's the most important thing about investing? It's to start. Who'd agree with that? In fact, even if in property, one of my friends, his name's Stephen, his first property purchase was in Queensland. He got ripped off by a 2-tier marketing company. And he got very pissed off. He actually lost nearly $100,000 on that transaction. That was over 10 years ago. And he's since become a property educator. Some of you would have heard him. He does a lot of, he speaks here in Australia and overseas. And the thing that he did was, and I knew him, I've known him for a long time, when he lost that money on that property, and in fact they flew him out into the Gold Coast, not only was the real estate agent on it, the valuer and the solicitor were also working together to make sure that he would overpay, 70, 100,000 above market. Now, regardless of what he paid 10 years ago, that property now has doubled anyway. Okay? But what he did was, he took that experience and he learned from it. He got so pissed off that they took advantage of him. He went out and got massively educated, and since then he's built a property portfolio of in excess of $10 million. And he actually speaks for the Academy. Now, how many people, if that happened to them, would say, I'm never investing in property again. We did it 10 years ago, we lost money on it, and I'm never doing it again. Who remembers in 99, 2000 on Current Affairs, there was all these people crying, mainly Melburnians, who got taken for a ride and they're all crying, they flew us to the Gold Coast and we bought this apartment, we thought it was $350 and it was really $280, and now John and Sue are struggling. Well, where's John and Sue today? How much are those properties worth today, I ask you? Because let me tell you, even if they've paid $150 above market, today they still have equity in those properties, because the property market's the most forgiving market out of any markets, as long as you buy and hold and never sell. So even those people that got ripped off in 99, 2000, and I'm not saying it's a good thing that happened to them, I'm just saying it's happened, it's a fact. Why don't they have stories today on Current Affairs revisiting those people in 99, 2000, showing where they are today and how much the property is worth today? Why? Because it's not worthy of a story, isn't it? Let's just do the doom and gloom stories and leave the successful stories away from the general public. So I would offer any of those people the prices that they paid for 10 years ago, quite comfortably, no problems. So this is the thing about property. Even if you make a mistake, I would rather people get in, make a mistake and learn from it, rather than do nothing. Doing nothing is the worst thing. It's the opportunity cost of doing nothing is just the greatest. The greatest risk in life is not to do anything, isn't it? There's 3 ways to become rich in Australia. How many people read the BRW Top 200 every year? There's actually 3 ways to become rich in Australia. Number 1 is to marry it. Or inherit it, or become a sports star or entertainer. The interesting thing is that out of the top 200, none of the top 200 are actually property investors, or they haven't become wealthy through property investing. 70% of them have property as the reason they've become wealthy, but they hold money in property, but they haven't made money in property, or they're a developer selling a product. So the first thing you've got to understand that no one in the top 200 is actually a property investor that has become wealthy through property investing. Okay, they hold money in property, yes, they do, but they haven't made money out of property. They've made it running a business or becoming a property developer and selling a product, which is property. So one of the hardest things to find, and this is, I think, one of the reasons why a lot of people don't make it over the first investment property, is actually finding someone who's doing it now and they're willing to teach you as well. Because When I was working at the NAB, working for Medfin and looking after all the doctors and dentists, I knew a lot of doctors and dentists that have a lot of property behind them. Do you think they would spend their weekends educating others on how to do it? Or do you reckon they'll hang out with their family and friends? Yeah. So there's no secrets. Like people talk about, I see all these emails I get all the time, learn the secrets of the super rich. I can tell you now, there's no conspiracy theory out there where the rich in Melbourne get together in Brighton every weekend and check on everyone. Now, you didn't tell anyone how to do that? Yeah, good. Okay, well, let's keep everyone in the dark. Okay, we're going to keep all the secrets to ourselves, and to keep the middle class. It's just BS, isn't it? It's not really secret. It's just knowledge that is not accessible through the market because no one's really educating it. And this is what we do at 21st Century Academy. I mean, we educate people on stuff that really a lot of people just don't know about. And property is just one aspect of our education. So the top 200 is a good reference point, but I'll show you another thing you should be reading every year, which is, or become an investor or become a business owner. Who's ever heard of Capgemini, the Capgemini World Wealth Report? Okay, hands up. Just want to see how many. Just a couple. Okay. The Capgemini report. Capgemini is a company that is the advisor to people like Merrill Lynch. And what they do is they study ultra wealthy individuals or high net worth individuals, and every year they actually release a report that gives you an insight on the wealthy individuals, where they invest their money, their asset allocation, meaning how many properties they hold directly, what is their asset makeup of their investments. And when I'm talking about high net worth individuals, I'm talking about people that have a US net worth of 20 million plus. And these are investors that are in the market today. It also gives you an idea of how many solicitors they use and which solicitors they use, financial planners, accountants. Do you reckon that's something worthwhile reading every year? And it's free. Absolutely. So this is probably one of the most interesting things that I read every year. You can download this on the internet, it's free, and have a read over it and find out what the wealthy people are actually doing. So one of the key things is you've got to start learning from wealthy individuals. And one of the problems in Australia is the advice that we are getting from accountants and financial planners, this advice to me is worthless if they don't have the results. So the number one thing you should be doing is this. My accountant, for example, has 46 investment properties, personally. The first question you should be asking your accountant is how many investment properties do you have? Now, he doesn't have to have 46. If you've got 3, that's fine. But it has to be more than you. If you've got 7 and he's got 2, he can't help you, can he? That's when you say, thank you very much for your time, love the office, get out of there. So your team of people around you, I'm talking about your real estate agent, your accountant, your financial planner, your mortgage broker, they have to be investors themselves, especially your solicitor as well. And they have to have personal results. They're the only people that can take it to the next level. Isn't that common sense though? But common sense is not so common, is it? It's like, it makes sense. If you're, for example, like getting coached by someone in a particular area of sport, in tennis or whatever it is, wouldn't you want that person to already have those results that you're aspiring to have? So why is it that we don't do that with accountants and financial planners and solicitors? Why is it that we never ask them, how many properties do you have personally? We just take their word for it, that that's the good advice. And I would say accountants especially can make you or break you, or they can cost you so much money in ill advice. Who's really pissed off at an accountant because of ill advice? Yeah, look around the room, right? The thing with high net worth individuals is, and this is the interesting thing about these reports, is that high net worth individuals do not invest in anything that is not available to the general market. But high net worth individuals have a greater propensity to, number one, observe, discern, and take action. There's a saying that people say, in order to become wealthy, you've got to be at the right place at the right time. Who said that before? See, I don't agree with that. I think you've got to be at the right place at the right time and have the awareness that is required to take advantage of the situation. Because I reckon you've driven by a lot of property opportunities. Property opportunities meaning that you could have purchased at a cash flow positive or you could have purchased for rezoning. But if you don't have the level of awareness that's required to take action, you don't see the opportunities. And that's why when you go to seminars like these, when you start getting a little bit of education, your eyes start opening up, and then when you're out there in the market, you start seeing all these opportunities because your programming is changing, your conditioning is changing, and your level of awareness is increasing in property. And this is what really these workshops are about. So your wealth psychology training is the key. How many seminars have you attended in the past? Who's attended more than 5 property seminars in the past? Congratulations. How many seminars have you attended? And also, how much of the knowledge have you specifically implemented? I would give you the advice that you should be spending at least or a minimum of 10% of your net income every year on personal development or education of your choice until you have the results that you want. If you're on 40 grand, you should be blowing 4 grand a year on education. If you're on 100, it's 10. Now, people say, well, education's expensive. You think education's expensive? Try ignorance. Try going through life not knowing any of this stuff and then suddenly realising, in your 80s and 90s that you could have done all this stuff 50 years ago, but if only someone could tell you to do it. Who feels like, for example, and I mean, you really, over the last day and a half, there was a lot of content, but I mean, this is just the top of the iceberg. Who feels like, man, I wish I knew this stuff 10 years ago? Yeah. And I'm going to show you more with property and how to structure these large property portfolios. So this is the thing I encourage all of you to do is, and not only with the Academy, go out there and go to as many workshops as you possibly can. Get the information, read the books. I always say the difference between you today and 2 years from now is the books that you read and the people that you meet. Now, sometimes you're going to have to let go of your friends. Okay? Because your friends and family, we can't let go of your family. We can move interstate, right? But your friends will hold you back. And meaning they're going to be negative when you come out with new ideas. Some of you go home and saying, I'm going to refinance my property into interest only because Konrad said this and this. And they go, what are you, crazy? Why would you do that? You don't want to do that. So your friends and family have a tendency to hold you back. Now, the reason they hold you back isn't because they wish you to fail. It's because they are scared that if you get different results, you will leave them. And people hate change, but people hate forced change more than anything. So they can't stand the fact that they might have to adopt not having you around. That's why they want to keep you roughly on the same level. Don't do anything and say, look, I'm just telling you because I love you and I don't want to see you hurt. So, you should maybe not invest in this property. What they're really saying is, shit, if this works and you get another property, maybe you stop hanging around with me because I haven't got any property. That's why the more you attend these events, your friends start to change. The friends that I had when I was working in managed funds at Australian Unity, none of them are around today. My friends are all investors and speakers at the Academy, etc. All the people that I hang around with now are open-minded. People like George Focus, for example, and all the people in our company. And we feed off each other. You'll never have none of those guys will say, oh, don't do that, that's not going to work. It's always, how do we make it work? So that's one of the keys, that not only do you get educated at these events, you actually create a network of like-minded individuals that you hang around with. Let's talk about the property bubble bursting. There's an article recently about the property bubble bursting. Now, this bubble phenomena reappears in the media, and I've seen this bubble thing for the last 14 years. Okay, and I actually collect articles about the property bubble bursting. And I've got a whole book of articles. Headlines, Fin Review, The Age, I'm not talking about the Herald Sun, of actually, mainstream economists and journalists predicting the property bubble that's going to burst. So what I've done is, and I want to revisit this, now the sentiment's back in the market. People think, okay, property's recovering again, it's a good time to invest. But I'm going to show you how you can use this to your advantage because it's going to happen again. There's going to be a point where property prices will again are going to go up a lot, and people's perception will be, well, it can't be sustained. They're just too expensive, it's going to pop and everything's going to disappear. So I use these as, I think these are like excuses that people have used for the last 40 years that stop them from investing in property. Now let's revisit these. In the early 60s or in the mid 60s, we emerged from a major credit squeeze and finance dried up and people didn't invest in properties in the 60s. In the late 60s, we had a nickel share boom and property was proclaimed an inferior investment. In the late 70s, we had a recession. Recessions are always going to be here. And it's the number one reason why people don't invest in property, because the number one fear is, if I buy an investment property and there's a recession, there's usually high unemployment. What if I can't get a tenant? If I can't get a tenant, I'll lose the property, I'll lose my house. Would you agree with that? So the number one reason why people don't invest in property is because of a recession. In the late 70s, we had rising inflation and the OPEC oil crisis. In 83, there was a recession with high interest rates and peaking inflation. That's another reason. In the 80s, commentators were saying that property prices in Australia are too high. They're unsustainable based on the average income of the average household, and they cannot potentially go up any higher than they are today. Isn't that interesting? In 85, the government introduced capital gains tax. Commentators in the Fin Review, financial planners, I've got names, I can't name them here, were saying, why would you ever invest in residential property where if you sell the property, you have to pay capital gains tax, where if you buy blue chip shares, you don't have the same problem. So people are predicting that this is the end of property investing as we know it in Australia. It's become a very much an inferior asset compared to other options out there. In the 87, we had a 1930 types of depression after the stock market crash of 87. So once again, people stopped investing in property. In 89 to 90, interest rates and inflation were very high, and we had the recession we had to have. Who remembers that? In the late 80s, we heard our children will never be able to enter the property market. Properties got up as high as 130,000 in Melbourne. Who can buy those? You know, I heard this same thing 3 years ago in a cafe. I was in Mentone in Melbourne, I was in a coffee shop with my wife, and I was overhearing the people saying, how can our kids buy in the area? They go to St. Bede's, Mentone's now about 600,000, you can't get in. I mean, if it's going like this, they'll never be able to own a home. It's the same thing's been said for the last, 40, 50 years. There's nothing new. In 91, we had record high employment, 11.3%. Once again, it's impossible for property to recover. Perception in the media was that property prices will remain constant for a long time. This is 91. In 93 to 94, we had Australians' foreign debt and current account deficit at record high levels. A lot of people were holding back, seeing what's going to happen to the economy. In the 90s, we had the world economic slowdown, the Asian currency crisis. In the mid-90s, we had high inflation. We had September 11. We had the subprime. It just goes on, doesn't it? Rising unemployment, potential recession, another property bubble. The interesting thing is that all these things are very valid economical events. Would you agree with that? And when they happen, the media just loves it. So all these things are events. Very valid events. Now, my prediction for the next 10 years, I'll write this down, is stuff is going to happen. Okay? But when these events happen, you can either react or respond. 95% of people are reactive, 5% respond. And you've got a choice of which one of these categories you're going to belong to. And the difference is the ability to conduct unbiased due diligence. That's all. If you don't know how to analyse the investment opportunity in front of you, you're going to be reactive and believing what the media is saying. Or you can respond. What was Warren Buffett doing a year and a half ago? Buying hard, wasn't he? Buying up banks because he thought, this is crazy, they're so undervalued and the fundamentals are there. But most people were selling because they didn't understand how to analyse the opportunity. They don't understand how to conduct due diligence. So the only difference between this group and this group, because I can guarantee you these events are going to happen forever. We're in a good place at the moment in Australia. It's going to change in 3 or 4 years' time. It's going to go into a recession. It's just going to keep going forever. Nothing's going to change. I've shown you the last 40 years. The next 40 years is going to be roughly the same. I can promise you. There's going to be the same problems we've had for the last 40 years. The difference is your level of education and whether you'll be able to take advantage of the market. And that's all it is. Now, the very fact that you're here on a Sunday, where you could be kicking back in the swimming pool with a beer, tells me that you're serious about your future and your education. Would I be correct? Yeah. So if you just go back to the slides, one of my mentors said to me, you can make excuses, you can make money, but you cannot do both at the same time. Would you agree with that? Yeah. And you hear people making either excuses or they're making money, but I've never seen a person that's making money and making excuses. This is the Dow Jones market since 1960. The bear market, there's a bear market and a bull market. Bull market goes up, bear market goes down. If you look at on the left-hand side, it gives you the year, the length of months that the market went down, and the amount the market went down by, and the reason it went down. So you got the Cuban Missile Crisis, the Cold War tension. And then he's got, on the right-hand side, he's got the bull markets. The year, the length of months that it went up, and the percentage. Overall, the market, on average, was down 13 months at minus 29%, and the average now, bull market, 39 months plus 92%. If these people just held through since 1961, could they lose money, providing the companies are still listed? No. So if you buy and sell, if you buy and hold and never sell, it's virtually impossible to lose money, and you just keep accumulating. Warren Buffett says, be fearful when others are greedy, be greedy when others are fearful. Isn't it a powerful statement? For you to become successful in property, you've got to do the exact polar opposite of what everyone else is doing in the industry, because most people end up broke. We've seen the stats, it's a fact. We've got census data showing us that most Australians retire on less than $400 a week. So if you just do the opposite of what everyone's doing, meaning the media's saying everything's crashing, no one's buying property, that's when investors go in, the 5% go in, negotiate discounts. When the market's hot, meaning you've got an auction, there's 30 people turning up, drooling and overbidding each other, that's the worst time to invest in property because you're going to be overpaying. That's when you lock in your valuations. So I just do the exact polar opposite of what everyone's doing. Is there another property bubble? These are headlines from the Sydney Herald Sun. 83, Sydney wins the Olympics. Property prices unlikely to rise. Interest rates cause for concern. Experts in 99 predict 20% drop in property prices. In 2002, has the property bubble burst? Possibly wrong time to invest, pretty good time to sell in 2002. See, it's funny in the media, they've got a very short memory, haven't they? Very short memory. September 2002, property bubble about to burst. 2003, is there a bubble? Now, how many people have seen companies and shares devalued to such an extent that they get delisted of the stock exchange completely? It happens, doesn't it? HRH, OneTel. How many people have seen a property, doesn't matter how bad the suburb is, devalued to such an extent that one day it just pops and the two properties come together on either side? And number 19's gone. Has anyone seen that? See, properties have intrinsic value. They've got land. And land goes up in value in the major capital cities. So properties cannot lose value indefinitely. Has there been corrections in the market? Absolutely. I'm going to talk about how to analyse the market and market data. If you look at Sydney, for example, which is a cross-section of the Australian landscape, I guess, because really there's only 3 markets in Australia as far as I'm concerned. There's Melbourne, Sydney and Brisbane. That's it. Can you make money in other areas? Absolutely. I'm sure there's people that made millions in Perth and Adelaide and every other, not any major capital city, but regional centres. But if you're looking at the population of each major capital city, if you just stick to those 3 markets, you're going to be fine. Who would agree that this is 107, what was it now? 1901, so it's 109 years of data. In 1901, you could have picked up a property in Sydney for about $1,000. Today, around 700. If your great-grandparents had the foresight to buy and hold through bloodline trusts and never sell property, could they lose money? If you don't sell, you can't lose money. Would you agree this is an upward trending line? Did people buy at the peak and sell at the bottom and lost money? Absolutely. Will people lose money in property? Absolutely. People are going to lose money in everything they do. That's not going to change. But if you've got a strategy where you keep on accumulating property and you've got a risk management policy in place where you don't get in trouble and overcapitalise, it is virtually impossible for you to lose money, especially if you know exactly what you're doing and which properties you're targeting. Now, these are the median prices in Australia from 1966 to 2008. In Brisbane, in 1966, the median price, which is the middle property sold in the market, was $9,700. And let me tell you, and this is what you've got to understand, that this was a lot of money in 1966. And I want you to write this down because when people look at these figures, there's one thing that they are missing. It's not the dollar amount that we're looking for, it's the percentage of household income versus the dollar amount. Because household incomes in Australia have spent between kind of 35 to 69% of the household annual income towards their mortgage repayments. So even though there was $9,700, let me tell you, there was a lot of money back then. Now imagine you said to someone in 1966, did you know that in 1976, the average property price in Brisbane would be $30,000? Guess what they'll tell you? How is that possible? We're struggling with our mortgage right now. We're not making ends meet. Are you telling me our property is going to be 3 times? Who's going to buy them? Are we going to have an influx of millionaires coming to the state? Did it happen? Did income increase proportionally to property prices? No way. Was it way behind? Absolutely. This is more than 10% capital growth. In 1976 to 86, it grew by about 10%. And then in 86 to 96, it grew just above 10%. But imagine saying to someone in 1996 in Brisbane that the average $132,000 house is going to be worth $475,000. What would they tell you? You're an idiot. How is that possible? We can't even make our mortgage repayments today. We're struggling with our mortgage. There's articles in the media about mortgage stress, and you're telling me that property is going to, what, triple? Who's going to afford them? It's impossible. In fact, I would love to track down retired academics, economists, and write an article in 1996 proving mathematically that it's impossible for those prices to go to $475,000 based on average incomes. And they'll probably do it. I mean, they wouldn't do it because they'll sabotage themselves, but it's possible to prove mathematically this is impossible. I'm showing you past history figures here because it's happened, isn't it? It's a fact now. It's not a discussion whether this happened. This is what's happened. So when I say in 2010, the median price is about $550 in Brisbane, it's going to go to 1.2 million in 10 years from now. A lot of people don't honestly believe that their house that's worth $550 now can be worth 1.2. They just can't accept it. They know it, they look at the stats, but they can't understand it, right? It's going to happen. The reason it happens is because people roll over equity from the previous purchase into the new purchase. And that's what drives prices. The reason prices go up is very simple. You've got a suburb that's established, it's been subdivided in the 50s, there's no more land left in that suburb. 70% of those properties are owner-occupied. Roughly 30% are owned by investors. There is no more land that can be created in that suburb. The suburb has a level of perception in terms of how prestigious it is, and there are suburbs next to it which are better, and there are suburbs next to it which are worse. The people from this suburb will never ever go backwards. They will always strive to upgrade the suburb or upgrade the size of their house. It's just human nature. So you've got 70% of the people in the suburb that will sell their house, get another $200,000 or $300,000 mortgage, and go to a suburb that's better based on whatever it is. It could be lifestyle, it could be schools, it could be hospitals, it could be highways, it could be proximity to the city. And this is what drives property prices. Because land is scarce, infrastructure is scarce, and it's been established. And that's all it is. I mean, it's that simple. So the only reason the property prices will drop is if this person that's sitting on an owner-occupied property for $1 million would suddenly agree to sell it for $600,000 and walk away with a $400,000 loss and downgrade into a worse house. Like, why would they ever do that? They would just sit through it. There's no way they could do it. I was talking to my mum the other day. She lives in a suburb of Melbourne called Bentley. And Bentley is quite a good suburb. It's probably about 7-8 k's from the city on the Bayside. The property that we purchased was $375,000 and we spent about $160 renovating it. And that was about 2001, 2002. I asked her the other day, it's worth about $1 million now, $1,050,000. I said to her, you know, if your house went up from $1 million today to $2 million, would you sell? And she goes, no. I said, why? Because I like it here. I go shopping on Centre Road, it's close to the beach, and my friends live here. I said, okay. What would happen if Bentley suddenly dropped to $500,000? Would you sell? No. Why not? Because I like it here. I go shopping on Centre Road, my friends are here. See, people don't move out of suburbs because they drop by 20%. What would happen if BHP shares drop suddenly by 30%? What would happen? People would dump, wouldn't they? They would sell. If a suburb for some reason drops in the median price by 20%, do all the families get up one day and say, come on honey, let's pack our bags? We're leaving, we're getting out of here. We're going to sell and go to a suburb that's worse. Would they ever do that? There's no way they'll do that. And that's one of the reasons that this market is driven not by investors' sentiment, it's driven by owner-occupied sentiment. And this is the problem with analysing the property market. The property market is not driven by investors. And that's why it's so hard to capture and understand why it does what it does. It's driven by the need to occupy a property, which is purely driven by emotion. And that's why all these economists and all these journalists trying to explain the bubbles and it's going to do this and pop and everything's going to devalue, they can't capture that information accurately because it's not driven by investors. Turn to your friend for 30 seconds, the person next to you, and talk about opportunities that you've missed out on in Brisbane of buying properties. I want to create some pain here. Where you had an opportunity, especially the baby boomers, we had an opportunity to buy a block of beachfront property for 10 grand, knowing well now it's been rezoned, high density, and you missed out on $2 million. 30 seconds. Alrighty, let's get started. So how many people shared stories where they lost over $1 million because they didn't take action? Yeah, it hurts, doesn't it? I thought it's only appropriate, being Sunday, that I'm going to teach you the 10 commandments of creating wealth through property. So for those of you who missed out on going to church. Okay, so number one is let's look at very simple how capital growth works and how do we buy property. In this example, we've got a property here with $500,000. Okay, which is probably, it could be your house, it could be anything. Let's say you've got an equity component of that property for $100,000. In 7 years' time, if that property is growing at 10%, now by the way, if you want to work out the compounding rule of an asset doubling in value, there's a very quick rule which is called the rule of 72. And the rule of 72 is basically this, that once you know what the average capital growth of a property is, let's say it's 10%, you divide 72 by 10, which equals 7.2, so this asset will double in 7.2 years. If an asset's growing at 7%, 72 divided by 7 equals 10 years, roughly. So the asset will double in 10 years. If the asset's growing at 5%, it will double in 14 years, right? Just a quick rule of working out when the asset will double in value. Just go back to the slide. So in this example, we've got one house. Well, we've purchased that property. And in 7 years' time, it's gone up to $1 million. Now, it doesn't have to go up to $1 million, but I'm saying historically we know that's happened since 1966. So you've got a net worth here of $600,000. You've got new capital growth of 500 plus the old equity of 100. And then in 14 years' time, you've got 1.6. So we know historically the property just doubles every 10 years, roughly, every 7 to 10 years. And that's been proven since 1966. Now, the pressures in Australia now are greater than ever. We're the only country that has avoided a technical recession. We've got record migration and immigration coming in. It's a great country, isn't it? It's safe, it's good to live in. People want to live here. I go overseas all the time and it's not, it's not as good over there as it is here. So people are drawn to Australia. So I think the rental pressures and housing prices are only going to go up because we've got record high migration and immigration from different states as well. So when you're buying your first investment property, the easiest thing to do is this. If you've got a property here and it's worth $400,000, you've got 100 in debt, you've got some equity of 300,000. The simple thing to do is just get a line of credit against the property or against the equity in your property and make sure that the line of credit is set up where you can get cash out. Now, there are different lenders now have different cash out rules. Like, for example, RAMS, you can only cash out 200,000, but there are ways around that. If you're trading Sharelord or you're trading any kind of share strategy, you can get a letter from your stockbroker saying that you've got a trading account and you're transferring money from one account to another. So there's ways around it. When you buy the investment property, and in this example, you're buying a property that's worth $350, so you're putting in $90,000 and you're borrowing $280, $90,000 because you've got funds to complete the transaction as well. That property goes from $350 to $700. So now you've got equity in there of $420. And the original property doubles again in 7 years' time. Now let me just show you a very simple example of how building wealth, this is big picture stuff, we're going to get into micro level stuff. I showed you an example before where you've got a property worth $500,000. And let's say on that property you've got $200,000 loan. So you can take out another line of credit for $200,000. And that's the 80% mark. So we take that line of credit and we set up what's called a master facility, which is just your line of credit sitting there waiting for you to buy an investment property. Now, when you buy your investment property, what you want to do, and I'll show you how simple this is, and I'm going to break it down into a very simple example. You've got this $200,000 line of credit, and you're buying a property with another $500,000. So to buy that property, you need a $50,000 deposit, and you need $25,000 to complete the transaction. So you need $75,000 out of that $200,000. So if you take away $75,000, you've got $125,000 left, haven't you, in that line of credit? And you've got a loan here for $450,000. Now, let's say you're paying 8% per year on your loan and you're getting a 4% rental yield. So if you take away the rental yield from, can we get a calculator up here? Christine or anyone in the room? In the back? No, they're all gone. They're at the pub already, are they? Anyone got a calculator? Why would you bring a calculator to a property seminar, right? Who needs them? Actually, that's the one I'm after. I always get these scientific ones that I've got to reprogram. And people look at me, come on, it's easy. Okay, so if we're looking at 450,000 times 4%, we're looking at $18,000 per year that we've got to make up. Now, how many lots of 18 do you have left over in the 125? Lots, haven't you? 6, 7, yeah? But remember, your rental's going up every year, isn't it? So you don't need exactly 18 grand every year. So don't you have enough money in your line of credit there to pay for the shortfall in your property? And just keep paying your mortgage at 500 and you've got this other property, just, it's there, isn't it? I'm not even talking about tax deductions, I'm not talking any of that stuff. It's just that simple. The easiest thing to do, if you've got a lot of equity in your property, is to set up a facility where your shortfall just comes out of your line of credit. And you just keep paying for it. Because eventually this property will become cash flow neutral, won't it? It could be 7 years, it could be 10 years. I'm going to show you how to find properties that will do it quicker than others. But this is so simple to do. Like there's virtually no risk because people's fear is, what if I can't find a tenant? That's the number one fear, isn't it? But if the vacancy rates are below 1%, and in Melbourne Bayside, for example, and in Sydney waterfront properties, there's areas where vacancies are 0.9% and 0.8%. The normal vacancy rate should be 4%. That's a standard vacancy rate, which means there's enough properties in the market just turning over. In Melbourne, there's areas where there's 30 tenants turning up to rent one property. There's rental auctions happening illegally. I mean, it's getting ridiculous. So you've got that problem solved. The other fear is, what if I lose my job? Well, you've still got your line of credit, haven't you? You've got enough here to pay for the shortfall. So if you're sitting on a lot of equity, and when I mean a lot of equity, I'm talking about a couple 100,000, you should be always buying property because even if you haven't got any cash flow coming in, why wouldn't you just do it? There's no reason you shouldn't. If you go back to the slide, you can see there that as you're building your property portfolio, the biggest thing that's increasing is your debt. Your investments are increasing, yes, your home's increasing in value, but property is all about debt accumulation in this example. And that's why I say the most important thing is for you to have a positive relationship with debt. Otherwise, you're going to have a massive problem of why it's always the worst time to buy property. Because property means debt. It's just that simple. Unless you're putting in 100% cash down, which I don't think anyone's going to do, you're going to have to borrow money. So the commandment number one is, money that you invest must be absolutely safe. There must be no chance of losing any of your money. Do you reckon that's a good principle number one? Yeah. Absolutely. Don't lose money. Residential investment property held over long term cannot lose money, virtually equal to having your money in the bank. Banks lend 80 to 100% of residential property because they know values have never fallen over the long term. In fact, the entire Australian banking system is underpinned by the continual growth of residential property. If our property market were to collapse And the property market at the moment, and I'll show you the stats on it, is worth 3 times more than the Australian Stock Exchange. If it were to collapse, then it doesn't make a difference if you've got property or not. We're all stuffed. Okay, so those people saying there's going to be a 40% drop, if there is a drop, the banking system would collapse. So it doesn't make a difference if you've got a house or you haven't. So you've got nothing to lose. If it happens, we're all stuffed. If it doesn't happen, you win. So to me, it's a fairly good odds. Banks lend up to 100% to any qualified person on average wage to purchase residential property wherever it's situated. I'll clarify the 100%. I'll show you how easy it is to get a personal loan and a mortgage and how to do it. However, banks will generally lend up to 70% on a small number of blue chip shares, and borrowers must demonstrate strong financials. Banks only lend 70 to 80% against commercial property due to the inherent vacancy risk. Also, banks rarely lend funds for businesses without some kind of property asset security because lending is extremely risky due to the fact that over the first 5 years, 95% of businesses fail. So they know the risk profile of different investments. They've worked it out. They make a lot of money. They know how to assess risk. Residential property market is massive. It's valued around $700 billion. It's 3 times the size of the Australian share market combined. So, and we're talking about residential. We're not talking about commercial or industrial property, purely residential property. Residential property investment is a low-risk investment because 2/3 of the market is comprised of homeowners who underpin the values, and 1/3 are tenants who have rental contracts in place. Plus, you've got landlord's insurance as well. So we're talking about the only part of the residential market that is open to, I guess, investment speculation is about 25 to 30%. And most investors only have one investment property. And it's not a fairly liquid market in the sense that it takes 60 to 90 days to sell your property. So it's not as reactive as a share market. It's underpinned by people that are non-emotionally attached, well, they're emotionally attached to the property for different reasons, meaning they're owner-occupiers. And it's only 1/3 of the market that is open to fluctuation. If you look at the stock market, it's completely different, isn't it? And what the media always tries to do is they try to, I guess, put a blueprint over the property market and explain it in similar terms as a share market. If the share market's collapsing, why doesn't the property market do the same thing? Where is your capital guarantee? Companies you have invested in can go bust or plummet in value. Westpoint, FinCorp, Australian Capital Reserve. In fact, the Australian Stock Exchange Top 200 was established in the mid-80s. I think it's 1986 that the original Top 200 was actually recorded. How many people know how many of the original 200 are still around today? There's only 26 that are around today. The rest have delisted, merged, or no longer make up the top 200. Doesn't mean they all went under. Okay, they haven't gone under. Don't email me. You said the other 174 went under. They just don't make up the top 200 that we look at now. Residential investment properties cannot go broke, and your companies and people go broke. Do you know any property that's lost value over the last 40 years consistently? Now, we all hear stories, not so much now because the market's recovered, about people that lost money in 91, 2000, right? Or 91, 92, 93, when the interest rates went up to 16, 17%. In Melbourne, one of the clients in Brighton, there's a dental practice, and the dentist that had that practice always wanted to buy a property in Mina Court, which is one of the best streets in Melbourne. It's on the Golden Mile of Brighton, right? Which is, the Golden Mile in Brighton is basically a mile of properties that are absolute waterfront where there's no highway between the front of the property and the beach. There's just sand and then there's water. So there's only a mile of those properties in Melbourne. The property was on a massive block of land, and this particular person was overcapitalising on that property. So they were selling the property for just over $1 million. Now, there was a lot of money back in 91. It was a huge land component with this property. This dentist wanted to buy it because he always loved the property and he had the cash to buy it. His accountant, financial planner, and everyone else was telling you you're a complete idiot. If you buy this property, it's the worst financial decision you can ever make. He bought it anyway. Today, it's worth about $16 million. He hasn't got his financial planners or accountants with him anymore. He's moved on. Now, what happened a couple of years ago in in Melbourne is an interesting thing. A couple of years ago, Toorak, which is our top suburb, and the same thing happened in Sydney, in the north suburbs, Toorak had a massive default rate on houses. So we suddenly had a lot of mansions over $4 or $5 million getting repossessed. In fact, in 1 month, I was talking to a colleague of mine at ANZ. ANZ repossessed 26 mansions in Toorak and they were selling them, but they were selling them very quietly. It wasn't publicised in the media because they didn't want a collapse of the top market. And the reason they were doing so is because what people were doing is this, and this is mainly because of financial advisors. You had very successful people buying blocks of land in Toorak, and let's say you get a block of land in Toorak for $4 million in a good location, and then they were building a house on that block for another $4 million. Okay, so that had a house with about $8 million, which was probably valued at 10 plus. And what they were doing is, now this is a cash transaction when there's no mortgages against this. You can't go for a mortgage for this much money. So this is we're talking about the top end of the market. When they had this much money in the property, the actual advisors were telling you, listen, why don't you get an LVR against that property for 50%? Get about $5 million out and buy some blue chip shares. You can't lose. So they took out $5 million and they bought some blue chip shares. Not only that, some of them went even further and did some margin lending against those shares as well. And guess what happened? The subprime hit, the market took a dive overnight, and a lot of these people got a margin call. So they got a phone call from the bank saying, listen, your ratios are wrong, you've got to release some equity. So at the same time, all these people got in trouble and you got these mansions on sale at the market at the very same time. And there's no market for these properties. These properties can sit on the market for 2 or 3 years. And I've seen properties at the top end just sit there for years and years on realestate.com. So yes, the top end of the market did take a 25% hit. But the properties that we're talking about are around the median price of every major capital city, and we're talking about the median price of the actual suburb itself. But what I would encourage you to do is, if you ever heard of someone that has lost money on property, and I'm sure if you dig deep enough with your friends and family, there's going to be those stories. Yes, Kevin bought a house and he lost money on it. I want you to find out 3 things about the property. Number 1, how much was it sold for originally? And I'll show you how to get this information through RP data. So what did Kevin buy that property originally? What did he sell? And what's the reason that he sold? And if he held on to that property, what it will be worth today? And is there a gap between what he originally bought the property for and it's worth today? You find it's not the property that lost money, it's the person that lost money because they overcapitalized, they took a risk. And they couldn't hold through the period in the market where it took a dive. And it was probably a top-end property as well. So if you go back to this slide again, if you buy and hold and never sell, it's virtually impossible to lose money. And that's the point I want to make with historical data. Number 2, you must achieve the highest possible return on the money that you invest as opposed to return on total assets. The whole financial planning industry is always talking about total asset return. Forget about total asset return. All that matters is how much money is leaving this pocket, how much is coming into that one, right? It's that simple. How much are you putting down? How much are you getting return on what you're investing? That's how you need to compare investment opportunities. So you've got to maximize the returns on the money by investing the minimum amount as possible. Always pay lender's mortgage insurance if you can. It's tax deductible. Always borrow the maximum amount that you can with property. Because if you put in 20% deposits, you can't get that money out in the first 2 or 3 years because you won't have enough capital growth in the property. Okay? You might, but you might not. But if you buy 2 properties with a 10% deposit, you've got 2 assets now growing for you. So as an investor, you want to maximize the amount of leverage, which is debt, minimize the amount of cash injection into property. And I'm going to show you how you can buy property with no money. I'm going to cover that today. Residential property gives you the highest return on equity as it's got the highest leverage out of any other asset class. So we've went through this table before. I just want to revisit it very quickly and just show you that the only variable here is the amount of debt that you're taking on. There's no other variables here. Meaning that the return on asset and the cost of funding is the same. It's consistent against all 5. What investment class always outperforms all other asset class in terms of return on your money, which is your equity, and why? It's residential property. And it's only because of the power of leverage. So using leverage provides you far greater return on your money that you can actually invest. So return on your money, not the return on the asset, is crucial in calculating your investment calculation. I'm going to use the property investor analysis software very shortly to show you how I actually analyze a property. But when I look at the property return, I always look at return on my money, not the return on the property itself. Choose investment properties based on capital growth, not cash flow. And we looked at the reason for that is because eventually you will become a low doc borrower, which means you've got to put in a 20% deposit. And in this example, where do you have more 20% deposit chunks? With property number? In fact, property number 1, in this example, not only does it give you more capital growth over 20 years, your actual rental is higher as well, even though the rental is only 4% and this rental returns 10%. Because it's not the rental return that you're looking for. People always go, you know, I want properties that are 7% rental yield. The rental yields will change depending on where the property is in the cycle. I'm about to show you that. But it's always a percentage of the capital growth value of the property. 4% of 2 million is higher than 10% of 657,000. One of the rule of thumbs that I have personally, if the property is returning more than 5.5%, I pretty much disqualify it automatically. Because my question is, why hasn't it grown in capital growth? In Melbourne, 5.5, what's wrong with it? It means because all the blue chip suburbs in Melbourne, like Williamstown, St Kilda, Elsternwick, Malvern, you know, all those blue chip suburbs, their rentals are 3.5%, 3%. Because they keep growing in value so quickly, the rentals can't keep up. So to me, if people go 5.5%, 6%, automatically the first thing that comes into my mind, why isn't it growing in value? What's wrong with it? And there's always an inverse relationship. You can't have value and capital growth. You can't have rentals going up at the same time as capital growth, unless it's a mining town. Number 3, you must invest your money in income-producing assets that return no less than 4 to 5% and outperform inflation. Now, some people have told me in the past, I've heard this, that, you know, property just grows at the rate of inflation. But it's not actually true. Residential property is one of the only investments where your income is virtually guaranteed, purely because your income is locked in as per your tenant agreement. Rental yields between 2003 and 2008 outperform inflation by 2.4%. Remember, companies have no obligation to pay dividends. How many people here own Telstra T1 or T2 shares? How many people could tell me, have you, and obviously you would have read the product disclosure document. What's the maximum dividend payout ratio for Telstra? It's 70%. So they can withhold 30% and reinvest it in the company. Can you imagine the tenant ring you and saying, Konrad, yeah, I'm paying $300 a week. I was thinking of keeping back $90 and investing in my PlayStation 2. What do you reckon? Yeah, sure, yeah. Do they have the discretion? Most companies have no obligation to pay dividends at all. They don't need to pay dividends. So imagine you're buying them for growth, but you've got no guarantee of dividends. The vacancy rates for all rented dwellings in Australia across 4 major capital cities over the past 15 years were 3.3%. So 96.7% of all dwellings paid rental income. 60% of shares that are listed on the stock exchange do not pay dividends. Only 40% pay dividends. Number 4, you must invest in assets that appreciate in value, showing proven historical capital growth performance. Specific residential property is one of the only investments where capital growth is guaranteed over time. The combined average compounded growth rate from 1960 to 2000 for Sydney and Melbourne, based on median house prices, was 8.87%. That's a fairly good return, isn't it? Since 1960. All these stats are from the Australian Bureau of Statistics, by the way. The combined average compounded growth rate from 1960 to 1999 for Sydney and Melbourne, medium-priced properties, outperformed inflation by 5.8%. Check it for yourself. Who's got a house here that they purchased 10 years ago, at least in Brisbane? Keep your hand up if it's doubled. Same hands, right? More than doubled, tripled? Look at that. Yeah. So if you're looking at the UK price, it's very similar. The UK's got a diminishing population, meaning people leaving the UK, where Sydney's got an increasing population. But you can see there, it's pretty much the same across the board, and we're talking about the last, since 1952. You must maximise tax advantages. We're going to cover negative gearing. And at 3:30, we've got BMT coming in for 35 minutes talking about depreciation on properties and how to maximise depreciation. After BMT, I'll continue on with property to about 7:30, 8 o'clock. We'll finish off pretty much at 8 o'clock. All the secrets will be revealed at 7:58 for the last 2 minutes. The combined tax benefits on the properly structured residential investment property can offset all holding costs, may even provide substantial positive cash flow, wiping out all your property expenses. I'm going to go through a specific example for clients that we've worked with. If you're negatively geared, then you can claim building and fixtures and fittings depreciation allowance. And here's how the government will contribute directly towards holding costs of your residential property. So this is the thing that I want you to understand when it comes to property. I've heard always people say, I don't like apartments, I only buy a house and land because land depreciates, etc. Or I don't like townhouses, this, that, the other. This is really what it looks like. If you're looking at a $400,000 purchase, if you're looking at house and land, townhouses and apartments, there's a different split between the land component and the building component. For house and land, we've got access to 26 house and land estates in Melbourne. I deal directly with the builder developer, so we can get them at the cheapest possible rate. Now, the average house and land in Melbourne is around 400,000. I can get them at 260, but I wouldn't recommend buying them, and I'll show you why in a second. I'll show you the actual houses. But a good 24 square home on a 500 square metre block will give you good rental. Okay, if you go any smaller, people start compromising size and they end up with a 13 square home on a 320 block, which I don't think is going to do well in rental. House and land, the land's worth roughly 200 and the building is worth roughly 200, including fixtures and fittings. When you're looking at tax deductions, you can only depreciate the building and the fixtures and fittings. So the building might be 150 and the fixtures and fittings could be 50, for example. The building can be depreciated at over 40 years at 2.5%. The fixtures and fittings have their own lifespan of about 5 to 7 years, depending on what it is. Some of the things you can depreciate over 12 years. If you're looking at a townhouse, the land on the townhouse, if it's 400, will probably be worth 150. And to build the townhouse, it's going to be around 250. Okay? So you've got a cheaper land component. Now this could vary because $400,000 townhouses are virtually impossible to come across in Melbourne and Sydney. If you're looking at an apartment, the land could be maybe 120 and the apartment could be 280. The reason it costs more to build apartments is because you've got commercial construction costs and usually you have underground car parks. The cheapest form of construction is just house and land. It's the cheapest way to construct anything. Apartments are actually quite expensive per square metre because you've got to usually dig foundations, you've got to do underground stuff, and that's very expensive per square metre. So you've got a different type of land component and different type of depreciation. Now, this is what I suggest you do if you're starting out investing. I wish I knew this when I started. No one told me this, and only years back when you reflect back, hindsight's always 20/20, isn't it? When you look back, you go, shit, I should have done this, I should have done that. But when you're doing it and mind you, when I was 18, this stuff wasn't around, and there's not many people educating people about property. I understand now that the goal of property is to secure as much asset or debt as you can. So if you start off as a full doc borrower, and the average full doc borrower, if you're on about $50,000 and you're a couple, you can probably, if you're smart, if you select the right lenders, you can buy 2 to 3 properties as a full doc borrower. Let's say it's 3. And then you become a low doc borrower. With a low doc situation, you're putting in 20% deposits. With a full doc situation, you're putting in between 5 and 10. So what I would recommend to you, and this is a really important point, is your goal as an investor starting out is to buy 3 properties as fast as you can and wipe out your entire tax bill completely. So you're paying no tax and you've secured 3 properties. And your selection criteria on the properties should be based on the first 3, not whether you like apartments, townhouses, or house or land. Which 3 can I select that I can secure the most amount of assets and virtually get rid of all my tax? Because remember, your tax, you're still working for your tax, are you not? It's still income that you've derived. The worst thing you can do is buy one property, max out, and then pay $25,000 in tax every year. Because that $25,000, where could that be going? Straight to your pocket. So, and there's no formula for this. It's more of an art form. You've got to sit down using the PIA software, which I'll show you after BMT speaks, and you've got to play around with different properties, and you've got to play around with different LVRs, or sitting down with one of our brokers and working out, how can I get 3 properties as a full doc borrower, max out, and get rid of all my tax? Okay, and that's really the art of property investing. After you pay no more tax, you should only be buying properties with the largest land component that has subdivision potential, located as close as you can to the major capital cities. Because remember, you don't care about the building anymore, do you? You can't claim any negative gearing benefits. So you don't really care after you max out your tax. The moment your income rental goes up and you've got a bit of tax left over, buy another property that's negatively geared. So let's get into negatively geared property. Now, before we discuss negative gearing, let me just show you what negative gearing actually means. It actually means this. If you look at rental yields, let's look at, for example, Brisbane. If you look at Brisbane, you've got 2 lines there. You've got the interest rate, which is the purple line, and you've got the rental line, which is the pink line. When the interest rates are above the pink line, meaning your mortgage repayments are much higher than your rental, what is the property? Negatively geared. When the lines cross over, meaning that your rental repayments are equal to your mortgage repayments, what's the property? Neutrally geared. When the line is below the rental line, which is here and there, which is 1982, 2000, what is it there? Cash flow? Positive. So can you have one property over a period of 30 years go through different transition phases and become cash flow positive, cash flow neutral? Absolutely. Because you don't, when you're driving through streets, do you see signs on houses, negatively geared, cash flow neutral? No, right? It just depends on when you secure them, and depends on the relationship between the rental income at the time and the amount of debt that you take on. The amount of debt that you take on is based on the value of the property, isn't it? So people say, I don't like negatively geared properties. Well, what does that mean? Because if you're putting in a 30% deposit, it's cash flow neutral. So property, negatively gearing is just a finance term that explains the relationship between the gearing, which is the loan, and the rental that you're receiving at the time. That's all it means. It's got nothing to do with the underlying asset. It's the properties is not mentioned. There's no such thing as negatively geared property, cash flow positive properties. Because if you can see here, the same property can transition through all different phases. It goes from cash flow positive to cash flow neutral, to negatively geared to cash flow neutral. So it just depends on when you get into the market. That's all it means. It's the same for every other state. So you've got to be careful with these labels that people place on property. I'm not into negatively geared property. And they come up with these things like, why would you spend $1 to make 50 cents back where I'll buy something that puts money in my pocket? I mean, that's just such a silly thing to say. Obviously, that person has no idea on how to structure these property portfolios correctly, because it's just labeling things and making it sound so stupid. So let's go through a negative gearing example, and I'll show you a real example with clients that came to us. Now, it's not Bill and Mary, but let's say it's Bill and Mary. They came to us at a seminar in Melbourne. They've got 2 children underage. They're both on 55,000. She was actually on 50. He's on nearly 60,000. They had an owner-occupied property for 350, and they had a 294 mortgage. The goal was to purchase a $400,000 investment property with no weekly outlay. They actually came to me and they said, Konrad, we know we need to do something. We've got 2 kids, we've got a third one on the way, but we've got no money. And I said, well, how much can you afford to spend a week? They said, $0. I said, okay, well, what about $5? She said, no. I said, you can't afford $5? She said, no. We literally are living paycheck to paycheck, and we're already budgeting. We cannot even afford $5. Okay, well, how much deposit do you have? Nothing. She said, can we do it? Because we know we need to do it. We feel like we need to do it. We need your help. I said, do you have parents with equity? They said, yes. I said, bring your parents around. So the next seminar, they came with their parents. And the father was sitting in the front row with his arms crossed. This is all bullshit. Anyway, after the 2 days, they actually came to 21st Century Finance, and we actually took equity out of, they set up a joint venture with their parents, and they actually bought a house and land estate in Melbourne. And I'll show you the exact property they purchased and the estate they purchased in. But let me just show you how I structured this. And I've chosen this particular property purely based on the fact that it was cash flow neutral for him, slightly positive. So let me go through the transaction. The purchase price was $400,000. Now, because you're buying off the plan, you only pay stamp duty on the land component. You don't pay stamp duty on the building. So the exact capital or the purchase costs were $13,081, and I'll show you a breakdown of those as well. The current income, and I structured this just under his name, was $55,000. So the tax that he's paying is $11,325. The rental per week on that property was $350 a week, and they've allowed 2 weeks vacancy as well, okay, which ends up being about $18,018. So the new income is $73,018. But so what you do is your rental income is just income. Remember, it's 30% of your income, 80% of your rental. It just gets added together, whatever your rental income is. But before you can pay tax on that, you've got deductions on the property, which in this example is $32,125. And we've got BMT about to explain how you can get those deductions. So the new taxable income gets reduced by $32,185, which is $40,883. The new tax that you're paying on that income, or bills paying on that income, is $6,862. What was he paying before? $11,325. So his income dropped from $55,000 to $40,833. So the new taxable income is $40,833. The new tax that he's paying is $6,862, which is a saving every year of $4,463. The weekly saving is $85.83. From the previous example, deductions on this particular house and land is $9,812 on depreciation, which is building depreciation and fixtures and fittings depreciation. The interest component per year, $18,386. The property costs, which is property management, insurance, etc., $3,968. So the total deductions for the first year, $32,185. The weekly costs are finance, $353.58, rates and maintenance, $76.31. So the total cost per week, $428.88. So you've got your total expenses minus your rental, minus your tax, it's cash flow positive by $2. Now, the thing is, people say, well, wait a second, he's got tax there. How can you get to your tax every month, every week? I'll show you exactly how to do that. Because if I didn't do it this way, he couldn't afford to hold on to the property. They literally didn't want to spend even $1 a week. This is the more detailed breakdown. You've got $400,000, purchase cost, loan costs, total investment cost. The parents kicked in 50 grand. There's the actual CBA loan that they locked in, 5.04 interest only, fixed. Now in this example, because the client had no ability to buy a second property for at least 3 to 4 years, there's no way they're going to buy it, I actually fixed their loan to take out the risk. Interest repayments, $18,386, closing balance. This is from the PIS software, which I'll show you in a second after BMT speaks. So we've got rental income, rental expenses, net rental income, okay, $14,032. So this is how his shortfall per year is $4,355. That's how much you have to come up with every year. Then you've got your tax deductions. You've got your cash deductions, which is your loan interest, expenses and your rental expenses. They're your cash deductions, meaning you're paying cash for them and you're getting them back. And this is your non-cash deductions. Depreciation on the building, $200,000 at 2.5%, $5,000 a year. And depreciation on the fixtures and fittings and furnishings, $3,850. This is actually minimum depreciation. We can get much higher than this on a typical property. And then the loan cost can be written over 5 years, straight line, 962. Total deductions, $31,185. The property, if you look at 25-year capital growth history on the suburb, this particular property was in the, and I'll show you the exact property. If you look at the cash flow, is that going to make him wealthy in year 10 when he's getting $2,000 a year in cash flow? No way. What's going to make him wealthy is in year 10, he's got equity worth of $500,000. So in year 5, between year 3 and year 5, we're going to refinance his property, pay his parents out, give them back the $50,000 plus interest, and we're going to do another property for them. The next property we'll do will also be cash flow neutral. They still haven't spent any money. The money that they're spending is coming out of their tax. So how do you get money out of your income with every pay cycle? What you need to do is you need to fill out, now it's a 2010, but last year was a 2009 ATO, Income Tax Withholding Variation Form. This is a form that your accountant fills out and submits to your human resource department in your job. And what they do is it's similar to salary sacrificing your losses with every pay cycle. So what actually happens is the ATO allows for you to claim deductions based on depreciation of the building fixtures and fittings with your pre-tax dollars. So we're doing what the wealthy do. They get paid, they claim all the deductions, and they pay tax on what's left over. This is the form that you actually download from the website. And this is the actual the top of the form, which is the 2009 POIG Income Tax Withholding Variation Form. And there's the ruling, negative gearing, and there's the actual section of the code that allows you to claim losses on your residential property. So negative gearing is basically this. It has nothing to do with the property. It has to do with the relationship between debt and the asset. What they're doing is what wealthy people have been doing for years. And what wealthy people have been doing is this. They earn money, they buy investments, or they invest, and then whatever's left over, they pay tax. What majority of the middle class in Australia does is this. They earn money, they pay tax, then they spend, then they get a credit card, and then they try to invest, but it's all too hard by then. Would you agree? Yeah. So with negative gearing and the income tax withholding variation form, the reason it's so beautiful is because once you do it and you automate it, there's nothing left to do. Your losses get offset against your income with your pre-tax dollars. So because you're losing money on the property, you drop into a lower marginal tax bracket, which means you're paying less income tax. So the goal of an investor for the first 3 purchases is to buy 3 properties and get rid of all your tax. That's what your goal is. That completes the section on negative gearing. We're going to have a 5-minute in-room break. Coming up next, we've got BMT quantity surveyors. Now, BMT, the reason we have BMT speaking at our events is because the ATO has changed rules now where in order for you to claim depreciation on fixtures and fittings and building depreciation, you can no longer use accountants. You actually have to have a depreciation schedule, which is done by a quantity surveyor. Now, the beauty of depreciation schedules is this, that the ATO won't audit or question a depreciation schedule. The reason being is it's too much of a specialised area for them to go into, and there's no money in it. So the higher your depreciation schedule, as long as it's issued by a quantity surveyor, that's what you can claim. And we found time and time over that BMT has a reputation of providing the most thorough and accurate depreciation schedule in the industry. So a quick 5-minute break and we'll start off with the next speaker. After the next speaker, it will just be me for the end of the day. Thank you very much.